Only 3 of the 10 S&P sectors that are expected to show gains: consumer discretionary, telecom and healthcare, and then of course you have energy with these huge earnings losses. Is the assumption that that's effectively in the price now?
I think it is, and I think what people are going to be looking at as we go as we go through earnings season is, number one, volatility is down. This risk-off environment is over. Companies are going to be willing to provide guidance going forward. And it doesn't mean that they're going to say things are great, but a quarter or two ago they were saying is we can't provide guidance because there's just too much uncertainty. And just by being willing to look more forward, that's a positive. Bigger beats, and most importantly, the latter part of the year is going to have much better earnings as we cycle through difficult comps.
So just to summarize what you're saying, you're going to have a beat and raise from many of these CEOs through earnings now. Is that what, I mean?
Yeah, I don't know if it's going to beat and raise, but here's what's going to be: a beat, forward guidance, and better numbers in the back half of the year. This could actually be a positive response to what really will be a lousy earnings season, but nowhere near as bad as feared, and that's what I think the market's going to respond to.
How does a company issue any kind of guidance when Corona, Brexit, an election, central banks in general, a June hike maybe, are all in the back half?
Well, let's be honest. I think that we're going to be looking at zero rate policy, overly aggressive central banks for probably the remainder of this cycle. The real question from a corporate perspective, if the risk of a recession is off the table, business, and you don't see currencies moving wildly and currency vols come down a lot, they will have a little bit more visibility. It doesn't mean that they're going to be optimistic about the future and that there won't be risks, but I think they're going to be willing to extend that visibility a little bit more than they had been.
So, Jonathan, you've hung on to your S&P target, the one that you lowered just before January at the beginning of the year, which would imply a 9% gain for the S&P from here. Is this earnings recovery going to be good enough to get there?
It will almost be good enough. There's two things that we need, Sarah. Is you need interest rates back over 2% on the 10-year. Otherwise, there's no way that the banks put in a good year, and that won't get you, over the finish line. And you need oil to probably average over $40. We're just below that now, but there's been a huge move off of the bottom. I expect both of those things to happen. If they don't, I'll be too optimistic.
So to be clear, you need somebody to shift the bond market in order to return bank earnings to where you think they should be. You need a more hawkish view from the Fed in order to raise the stock market. Is that what you're saying?
I think that what you need is economic. Right now, if you look at the economic data, the ISMs are coming in back in the low to mid 50s. The jobs reports are good. If we stay on this path, it's the market that's going to push interest rates over 2%, and the market will drag the Fed. It won't be that the Fed's going to drag the market.
Because they like to be behind the curve these days.
And they're good at it.